Thank you so much for tuning into The Journey with Christian Evans podcast. This is where we always talk to amazing investors doing some cool shit. And guys, we have a really cool investor on today that we're going to be talking about. We're going to unpacking the Indian market and what the hell's going on over there and the opportunity that's going on, the growth, the trajectory, and why there's a lot of U.S. investors deploying capital in this region. And that's the reason why we have managing partner of Trifecta Capital, the one and only Rahul Khanna. Rahul, how you doing, my man?
I'm doing well, Chris. Thank you for having me on.
Dude, man, I'm excited for our conversation. And, before we dive into kind of the macro, trajectory of where India's headed and the opportunities there and the excitement over there, I want to talk a little bit. You mentioned offline 20 years in the venture space before it became the big thing. I'd love to just unpack a little bit about your journey. How'd you get involved with this and obviously the trajectory? And you mentioned like this is almost like you spent 20 years for this moment, for this experience, for this golden age moment. So I'd love for you to tell us a little bit about, man.
Yeah, I am possibly the oldest man in Indian venture capital. I began my career in the 90s in telecom, and I spent half of that in India and about half of that in Silicon Valley. Unlike many of my peers who continued to stay on in the US, in 2005, I sort of took that leap of faith to come back to India. I'd been in the Valley through the boom and bust cycle. So I'd seen both sides of the coin. And I really felt that experience of having seen the 0 to 1 journey in the US would equip me to do something really interesting back home. So convinced my wife to get on a plane, and we flew back to India largely on a wing and a prayer. And in a way, when I came back to India, what I realized very quickly was that there was tremendous opportunity, but no capital. And so I started dialing for dollars, and I reached out to a bunch of funds that I knew during my time in the Valley. And one of them happened to be a firm called Clearstone, which is now called March Capital. And they said, hey, we've just raised our second fund. It looks like India's becoming interesting. Why don't you set up the India office for us and start allocating capital? Let's find opportunities. Now, this is back in 2005, before sort of the giants like Sequoia and Accel and Lightspeed showed up in India. So I'd say I sort of stumbled into venture capital, and the only credentials I had was that I'd been a sort of an entrepreneur and a Silicon Valley sort of veteran, for want of a better word. And the truth is that really was the makeup of the venture capital industry. Nobody had any track record. There was really no evidence of success back then. And we sort of stumbled into it in a way. And it was really interesting because, things that we take for granted in the Valley and in more developed markets, like what is a term sheet, or why should I dilute equity, or you mean you want to sit on my board, were things I had to explain to founders. And so I think a lot of those formative years went in building the foundation for a very vibrant industry, which back in 2021 peaked at about 35 billion of investments into India by way of venture capital, right? So from a standing start, we went all the way to $35 billion invested. Now, of course, 21 was a bit of an anomaly. We're back down to kind of mid-teens billions, but that's still a very big amount of capital flowing into the country. So I stumbled into VC, spent 5 years at Clearstone, another 5 years at a firm called Canaan Partners, which was a larger shop, East Coast, West Coast, tech, healthcare, sort of learned the ropes of the venture business. But I also realized that, it's very hard for the tail to wag the dog. And the big dog was sitting in the US, and, candidly, that would occupy 90% of the firm's mind share. And here I was in India with 100% of my mind share in India. And I found that in the long run, I probably needed to build an independent firm where decision-making, allocation of capital, prioritization of time was done on the ground versus done elsewhere. And so, I parted ways. I'm still very fond of the folks at Clearstone and Canaan. I've leaned on them a lot for best practices. But it was time to go build something, as an independent firm. And so in 2015 is when we began building Trifecta Capital. And the headline numbers are, we've invested about 900 million into India across venture debt and growth equity. We've raised about 600 million. And we have an AUM today of about $500 million. So from a standing start, those numbers may not seem very large in the US context, but in India, it would put us amongst the top 10 investors in the country.
That's huge, and that's a great job on that. I want to double click on your first
Yeah.
time experience with those two other funds.
Yeah.
In 2005, that was many years ago, and so we were talking offline where India. We'll discuss this later, where it had to come from a developing nation to a developed nation, right? And that's kind of what the prime minister is focused on. There has to be talent and there has to be resources as well. And we're seeing that kind of right now in the golden age, and there are certain factors that had to fall in play to be able to have this kind of synergy right now, this environment. But when you were working with those two other firms, early 2005 timeframe, what was your guys' strategies? Did you guys create like almost an incubator process, incubator focus to be able to have a very operational control with these companies and founders? And did you have like a play of, hey, small checks and a quantity deals because you didn't know which one were going to pop and which one? Because there was a lot of constraints that were on these businesses and on these founding teams. So I'm
Yeah.
curious, how did you think about it and navigating that?
Yeah, it's fascinating because we're talking like pre-iPhone era, right? So, the whole thing sort of transformed when India went mobile in a big way, and when we started to see the rise of the sort of Android ecosystem, which was more like 2010, 11, 12 timeframe. But in the era that I started investing, there were broadly two strategies. One was to build companies from India for the US, because historically, we'd already seen evidence of software companies in the US being built in the US with back offices in India. And we said, why can't we sort of start them from here and go after global markets? And there's a lot of talent on the ground. Some of them have worked in the majors. So the good thing about India is it's been where Google and Facebook and Microsoft and IBM always had development centers. So one of the unique things about India was, while maybe the market was not as open, the talent was already here, and the talent had been exposed to the best practices of building software for the world, including with the kind of the Y2K, the experience of the IT transformation had already happened in India. So we had this ready bench of talent that understood how to write code, bless you, and how to build product, but didn't have a lot of go-to-market experience. So phase one was just trying to figure out how much energy do we chase on US versus, in a way, recreate the journey of the internet experience as it played out in the US. So if you think about way back when, a lot of the consumer internet began with information, and then it moved into kind of horizontal commerce, Amazon, and then moved into vertical commerce. So really the wave of venture, in a way, followed the playbook of the evolution of the consumer internet, particularly around domestic consumption. So we had companies that started by organizing information, which became the equivalent of the classifieds and the news sites, which were media models. And then we had, India's answer to Amazon, which was a company called Flipkart, that eventually Walmart acquired for just shy of 20 billion, which built out a horizontal e-commerce proposition. And then we started to build vertical businesses in auto and real estate and things like that. So sort of, in a way, the playbook was a little bit of copy and paste, because we were targeting the first 100 million users. And you and I talked about the fact that India has a large middle class. And really that first 100 million, represented the lion's share of the opportunity. Because when you got past that 100 million, the ability to transact online, not having credit cards, not being digitally savvy, at that time not being on mobile devices, made it very hard to access them. So you really were building to this core group of, let's call it 20 million households or 100 million people. And so, it was the size of, say, the UK or some part of Europe as kind of the core demographic that we were going after. I think then there was a wave where people started to look at more B2B and lots of services that took away all the inefficiencies with distribution in India, logistics, supply chain, warehousing, things like that. And then we finally got into a point where, like in the US, AI is transforming everything. We're starting to see a lot of core technology, some fundamental innovation, and which is now 20 years into the venture journey, right? Because we've also moved from serving the first 100 million to serving the next few 100 million, because everybody in India has a phone, everybody has a bank account, at least the people we care to serve. and they're all now digitally native, right? So I don't need to explain to somebody what is an app, how do you use it, how do you pay, can you pay? All of that is taken care of, right? So India's sort of transformation really came from the fact that we embraced mobility, that people were digitally native, that they all had bank accounts, and that this infrastructure was effectively free, right? The government provided a lot of these capabilities. They provided the rails to transact securely remotely. And that, is kind of called the payment stack of India and anchored around something called UPI, the Universal Payment Interface. So I think that then moved the addressable population up significantly, which is why today we have companies like Zomato, which is effectively, an aggregator and a quick commerce company valued at $26 billion.
And one of the things that I find so interesting about this, I love what you're saying in copy and paste. You're able to, learn from the U.S. markets. And I was talking to, like I mentioned offline, a friend of mine that's in the Dubai UAE region, and they do a very similar approach where they say, okay, which ones are working over here in the U.S. and they can almost copy and paste that same kind of business model or business product into their market. And whether that's bring them that company over to that market and say, hey, we want to help you, expand into this, or create a startup and fund it themselves and then create that very similar product. And so India is very similar in that. And like you mentioned, there had to be certain things that were in play. You mentioned something I want to double click on as well, because here in US, I do understand like in green tech or climate tech industries, there's kind of a public and private partnerships a little bit where there has to be certain public initiatives or incentives that have to be in play because they have to provide that like the baseline. And you mentioned just earlier on, the government, it sounds like in India, had that kind of development so that there was access to some of these products, these apps, these services. So the foundation was built. Therefore, it made these products and services a little bit easier to evolve into these ecosystems and customers and clients. What other partnerships, public and private, had to be established when you were looking at investing, maybe with those two funds or currently as well? Just I'm curious what the evolution looked like.
Yeah, look, I think we sort of take regulations for granted, but the regulations had to evolve to be able to accommodate, pooling vehicles like we exist today as fund structures. Much of that, came about in the early part of that journey. We had a whole regulatory regime that had to be formed around private markets, how to treat taxation, how to shield investors from losses at a fund level. So along with the subsidies that the government provided or the conditions the government's created for kind of democratizing payments, the government also played a role in giving investors the comfort that private markets can be safe. Because, again, India's journey with alternatives in private markets is 20, 25 years old. The oldest private equity funds was sort of late 90s. So, it's not that long ago that we didn't even have private market products. So I think along with the, kind of work the government did on policy, they also did a lot of work on regulation. And we have actually a very good markets regulator, SEBI, that regulates the fund management industry. And that, continues to be something that is evolving. The government has now seized upon the idea of creating a new jurisdiction, which is called Gift City. And that jurisdiction becomes now the preferred pooling vehicle for offshore investors who otherwise would have pooled in a Cayman or in a Mauritius. So I'd say the second plank really is regulation and recognizing that, investors need to be provided the confidence that they are well looked after. And I think that's an important sign, and which also makes India much more attractive to global investors because they know that there's a very robust regulatory framework. And to some extent, the laws of the nation and the rule of law, protects them, right? Because I think in a lot of emerging markets, you worry about kind of rule of law. And candidly, the Indian courts, didn't always operate very effectively. So I think there's also been changes by way of new bankruptcy laws, new arbitration clauses that allow people to recover money much more quickly than before. Because otherwise, the challenge was winding up a company could take a very long time. Those things have now become a lot easier. So again, things that we take for granted in the West, a lot of that had to be built in the last 20 years. But I think we've kind of leapfrogged, right? And we've been able to very quickly play catch up. And so today, the regulatory environment in India is very progressive, and a lot of investors that otherwise would not have considered allocating capital, including lots of family offices, are very active in private markets now.
You're seeing when you're seeing a lot of capital allocated now currently in the markets, where are you seeing some of the industries where a lot of the capital is flowing? Are you seeing a lot of deep tech, biotech, life sciences? Are you seeing more of, you know, consumer businesses, things like that? What or
Yeah,
CPGs? What are you seeing that, you know, overall that is
yeah.
exciting for outside investors?
So, I have a sort of a framework that I have sort of brought to bear around how I think about the journey that India is on, right? Our constitution says that we are a sovereign, socialist, democratic republic. And so India had a significant public sector that when I was growing up, we had one telephone company, we had one bank, we had one insurance company, and one television channel, right? And I'm talking about the 70s. So the role of the government and the role of the state was very significant because we came from a sort of background that, in a way, there was a bit of a socialist overhang, and the government was the provider of everything, and everything was licensed and regulated. And so we had this term called license Raj, which meant that if you needed to get anything done, you had to go get a license. So the journey that India's been on is actually this journey of what I call public good to private offering. So 30 years ago, telecom, banking, media, and insurance were public goods. And you took for granted that the government would provide dial tone, the government would provide a TV channel. If you look fast forward to today, these four sectors have been completely transformed by private enterprise, including Jio, which is now looking at $100 billion IPO for its mobility business, right? So banking, insurance, telecom, and media transformed, innovation, incredible competition, great service, really low prices, right? So these four sectors have been completely transformed by private enterprise and private capital. So these were public goods of yesterday, they're private goods of today. The public goods of today, which are going to be transformed, which is where money needs to go, is things like healthcare, education, energy, food, and transport. So if you just think about these five things, these five typically take up 50% of share of wallet for the average Indian. So he or she spends on healthcare, on education, on food, on energy, and travel. And these are still largely government controlled and operated. So the government still provides primary education, the government provides primary healthcare, the government runs most of the transport, it runs the railways. And I feel like the journey over the next 20 to 30 years will be to fundamentally unlock value by transforming these public goods to private offerings. And so, again, it's kind of skate to where the puck needs to go to. So really looking out and saying, okay, how can we transform healthcare so the government doesn't have to be a provider? It could just be a provider of subsidy, but not in the business of healthcare. How does it not get into the business of education, right? How do we move transport and privatize it? So that's what I'm excited about. Now, candidly, it doesn't require lots of technology. Every business is a technology business today, right? Every business has to have that capability. But I think these are problems of access. And therefore, you need new solutions, and people need to think about a combination of a virtual classroom and a physical classroom, a combination of virtual healthcare and physical healthcare. So those are the kinds of innovations which require first principles, bottoms up thinking, not, hey, what worked in the US? Because it's a totally different context, right? So you can't say, and candidly, you don't want the NHS because the UK health system is completely controlled by the government, right? So I think those are the kinds of opportunities and challenges which capital needs to chase, because this is where the share of wallet is. And this is where all that dollar flow is going to go to from the consumers in India. Now, as it relates to, kind of core tech and biotech, et cetera, we have those resources in India, but we don't necessarily have market access, and we don't have the ability to monetize those investments as well as one could in the US. So I think a lot of that innovation will continue to be around serving markets outside of India and not necessarily in India. But I think once it becomes well accepted, we can crash the cost down to make it accessible to everyone, right? So in the same way that, cancer drugs in India cost a fraction of what they cost in the US, because we made them all generically in India and they came off patent, and, most of that manufacturing is done from here. We think we can provide accessibility to 1 billion people. But the fundamental innovation and the early monetization will still happen in more mature markets.
When you're seeing the evolution of these startups and these companies that you're working with and, funding, when I was talking to someone in Israel, these startups in Israel, what's interesting about them is that they go to market in the Israel ecosystem, but then very quickly they hit that market cap, and so then they have to look at obviously external European markets or the U.S. market to deploy their product, et cetera, to increase their market share, et cetera, et cetera. I'm curious, because India is so large and there is a really good synergy right now, do you feel like when you're looking at the evolution of the business, because there's so much market potential in India alone, is that a problem that you all have to face, where you have to look at it and say, well, we got to look at the European market, we have to look at maybe a US market to be able to participate that, because we're trying to increase the market cap, we're trying to scale, et cetera? Or is that not even a factor when you're looking at this?
I think Israel has some amazing capabilities. The challenge is a very small market. And so the Israel model is, build in Israel for the world. The Indian model is build in India predominantly for India. So we have a very large market. I will say, though, that, it's easy to get seduced by like the billion population and all of that. The honest truth is we are a sort of low to middle income economy, right? The GDP per capita is give or take $3,000 and rising. I think at about $5,000, $6,000, it starts to get quite exciting. But, there are different pockets of India, right? So there's 100 million pocket, then there's another 300 million. And then everything beyond that is actually quite poor. So really the way to think about the Indian opportunity is, 400 to 500 million people that one can serve, that have the ability to spend, several $100s a month on various products and services, right? And so I think we don't necessarily need to look outside. I think if you're building a technology business, software company, SaaS, AI-led, then you really do want to go abroad, because I think monetizing those technologies in India doesn't lead to the best yield. If you can sell something for $2 in India, you can sell it for 10 outside, right? So generally speaking, if you're building a technology-led business and a software or product business, then you do need to think global. If you're building a consumption-led play, consumer products, logistics services, e-commerce, all of that, we don't need to look beyond India.
This is a question I've had. So I was partnering with a social media app, and they were looking to expand outside the US because there's kind of international social media structure a little bit. And I was in charge of working in India and Asian markets and so forth. And what was interesting is the cost per download to acquire someone to download the app was like relatively small compared to the US markets or any other market, Europe. However, though, what was interesting is it took us the longest time to understand that kind of clientele. Just like you said, they are lower income. The wealth and the resources aren't as much. There's a large delta, large gap between. And we just had to cater and adjust the pricing drastically. And, it was a very interesting research for me to understand a little bit. So I'm thinking, when you're working with these companies and you're helping them go to market, when you're looking at pricing and product and marketing and the margins of these businesses and the scale of it, is it pure the quantity number where it's like, hey, look, we're gonna we're gonna play the quantity number, we're gonna have 3 4 5 million users each buying 10 20 30 40 US dollars in the same congruency, or is it, are you thinking like more premium products, et cetera, et cetera? How do you think about that? I know each startup is drastically different, so
Yeah.
I understand like each product is so drastically different, but I'd love for you to give me an example of how you think about that when you are going to go to market,
No,
and your
it's a great
clientele.
question because companies kind of get, sometimes they get torn between serving the top of the pyramid and the middle of the pyramid, right? Um, and these two are quite different because there's a segment of India that's quite sophisticated, willing to spend, has the discretion. And then there's a very large middle that actually is quite vicarious. They don't particularly feel loyal to a brand because they're sort of beginning their journey with brands today that they don't know. Every time a new brand shows up, they want to try it out as well. They're much younger. They're in their early, in their teens and in their 20s. So I think what I tell founders is pick one, right? Because these two markets require very different, strategies in terms of adoption. Because you don't want to spend on acquiring this customer with this kind of cost of acquisition, right? Because if you're spending $5 and this guy's only going to give you 5 in a year, it's just not worth it, right? Because he may not be around in year 2. So I think what we've seen is, if I take the example of a company like Cred is a company that was very focused on the Amex, or the American Express profile of customer, right? The Amex premium customer. And they built a model around payments, rewards, and credit, really for the top 5 to 10 million population of credit card holders. And they've done a really good job of staying true to that demographic in terms of the positioning, the messaging, the pricing, the capabilities. Even the credit products they offer are to highly credit rated customers. And they've stayed disciplined around that. Company, incidentally, is valued at about $6 billion. So that's one example of staying at the top. The other extreme example is a company called Meesho, which is in the horizontal e-commerce space. And they said, look, there's no point trying to compete with Amazon and Flipkart for the first 100 million people. We just want to focus on the next 300 million people. So we're not even going to bother focusing on the top 20 cities. We're only going to build our business by servicing the next 100 cities. And that company, incidentally, is also valued at somewhere between $6 and $10 billion today. So you have two different examples: Cred, which is CRED, which is focused on the top of the pyramid, and you've got a Meesho that's focused on the middle of the pyramid. And therefore, they have to adopt very different strategies on pricing, on customer acquisition. Interestingly, Meesho began like as a reseller platform using WhatsApp groups, and then eventually evolved into having its own app and building trust and building logistics and supply chain and payments. And today is, Amazon and Flipkart's worst nightmare is Meesho, because it's growing. It's the third largest e-commerce company in the country that you never heard of, because it's not going after the top 100 million consumers.
Very interesting, very interesting. So you really got to know your ideal, your client at a very deep
Yeah.
level and who you're
Yeah.
working with. So when you're looking at that growth stage and helping them scale whichever industry, whichever clientele that they're kind of focusing on, is it through an advertising perspective, advertising marketing perspective? Is it a network effect approach? What are their growth strategies that they are implementing? And again, I know it's contextual depending upon obviously what
Yeah.
product and ideal client, but I'm curious what you
Yeah.
see.
Look, I think there was a time when people were throwing a lot of marketing dollars at it. And I would say, the tragedies of that 30 billion that came in, probably 10 billion went right out the door to Google and Facebook and all the other media platforms that were around at that time. I think people have gotten smarter about it. They're getting much more thoughtful about, retention, cross-selling, upselling. So the battle is not as much, can I add more users? I think the battle now is, okay, I've got 20 million customers that come to me every month, every day. What do I do with those 20 million people, right? So we've got a company called Daily Hunt, which is like a news aggregator. But when TikTok got banned, they also launched a short form video company called Josh. So now we have a media platform that aggregates media and gets paid, a fee for people to consume a wide range of media and news from wherever they're at, right? And India, of course, is a big country. It speaks many different languages, and people move around. So people want local news. They want news from their town. They want sports news from here. So this is a news aggregator called Daily Hunt. And then we launched a business to sort of see if we could build, it's hard to build a better TikTok, but build a TikTok-like business, which has taken a while, because you thought, okay, let me just go get the influencers. And I think that was a natural first place to start, which is, hey, gather all these influencers. But the truth was that TikTok has a lot more under the covers in terms of the capabilities that they have by way of data and analytics and tools that they perfected. And they're a great product company, right? So you can't just go after the influencers. You've got to go build great product that empowers the influencers and gives them the capabilities a la TikTok and all the intelligence that TikTok has on making it really sticky and engaging. So I think we're learning in a way that eventually need great product. You can throw marketing dollars at it. You might get people in the door, but you can't keep them, right? And I think what we've seen, with what Insta has done, particularly in India, is they've nailed the product, right? They've done an incredible job of actually getting product right. It's become a great contextual commerce business in India. And so I think we are inspired by the success of global players. And, we never put up a Great Wall of India, right? So the Facebook of India is Facebook. The Google of India is Google, right? We don't have necessarily sort of a homegrown version of those businesses in India, right? That said, if you can beat a Google in India, you're doing really well. If you can beat a Facebook in India, you're crushing, right? So where Indian companies can win is what I call where businesses are not built in the air. The Googles and Facebooks are built in the air, so they can compete globally. But when you have to move stuff around, when you're dealing with sort of atoms and not bits, is where the Indian companies can succeed, right? Where they can compete because they understand the lay of the land, they understand logistics, supply chain, procurement, just the heavy lifting stuff, right? And so we sort of make sure that our companies play to their strengths. And for everything else, just go, buy Google ads, right? So
I love that. It's a competitive advantage compared to some
yeah,
maybe larger US companies, et cetera, that are coming in dominating maybe certain specific, products or whatever. But at the end of the day, your competitive advantage is saying, hey, look, this is the landscape. We know this geography. We know this, we know this clientele. We know this industry, et cetera. And, deploying that competitive advantage. I am also intrigued. So I was talking to a friend of mine in the European markets, France, anything like that. There's this constraint of capital, right? And they don't have, unlike US, where it's like, well, recently we've had a hard time, but some of these companies have relied tremendously on the next raise, a bridge round, a higher valuation, et cetera, always just burning cash. And that is a terrible situation because then you're never able to actually build a company that's profitable. And so I find European markets and others that have that constraint of capital, if you will, have a way to be more efficient with their resources, their time, their energy. And then also you mentioned something as well, the evolution of the talent in India has been making compounding effects. So there's huge amounts of talent, but still, obviously needs some movement in that direction. I'm curious, by having those two constraints, one, do you see the business more efficient? Because now all of a sudden, not only do you have like the COO of a company being just the COO, maybe he has to run into being the marketing and the salesperson as well, and maybe the financial person. Because now all of a sudden you're more omni skilled, if you will, in the company because you can't rely on as much talent for specific criteria. So I'm curious with those two constraints in India. And again, I'm not saying that India is not skilled. They have incredible amount of skills and they have incredible amount of talent. All I'm saying is I think that is a logical constraint in these businesses. So I would love to free to think about that. And obviously, what are you seeing in regards to the efficiency and effectiveness of these businesses?
I think there's a couple of threads there that are interesting. So, venture is not just about money in, it's also about money out. And I think the US venture market at this point is probably suffering its worst drought of money out. Conversely, India's actually had a spate of IPO activity within the tech ecosystem. And what we've seen is that the companies that went out, that were loss making, that did not get the memo, have actually been punished by public investors. The companies that figured out that public markets will reward profitable growth have been rewarded wildly. And so, very quickly, that message has gone upstream to the younger founder community and to the guys who are looking to go public eventually, that really what you want are three attributes in your business. One, you want to be, in a way, a trusted household name, a category leader, a brand that people know, a brand that people use every day. Because a lot of the Indian kind of financial market is very retail driven, and people just trust brands that they know well, and they're happy to invest in those brands. Two, you want to definitely have growth rates that are attractive, but they don't need to be 100%. So if you're growing at 20 to 30%, which is not low, but if you're growing at 20 to 30%, that's fine. You don't need 50% growth to be an attractive company. But most importantly, either you need to have a clear path to profitability or you need to be profitable. Because the Indian investor does not give growth a premium over profitability. Because we've got a ton of profitable public companies. So why would I bother investing in loss-making private companies if I can just go buy a stock that's going to compound at 25% forever and ever, right? So I think the constraint is coming by way of people understanding that finally the moment of reckoning comes when you go public. And that's when the private world and the public world kind of collide. And we had, it's kind of our first, I call it an India's Netscape moment, which was kind of 2021. So 1995, I think, is when Netscape went public in the US. And maybe some of your people may not even remember Netscape, but I remember it because I was around then. But that led to sort of a whole generation of technology companies sort of going public, the whole market understanding how to think about these business models, how to value these companies. And of course, the Indian public markets had to go through the same experience because many of these were kind of N of one, right? People had never experienced a public stock of this nature. So they didn't even know how to comp this because there was no comp, right? Now, 3 years into that journey, there's about 35 venture-backed companies now that went public in the last 3 years. The combined market cap is now $100 billion. So we have 30 companies that were private, that went public, that are now worth $100 billion. We have another 150 to come out, including Swiggy, that's coming out right now, that should be valued at between 8 and 10 billion at the IPO. So I think the constraint is coming by way of people saying, finally, I want to create value for myself, for my investors, and just being a cash hog doesn't solve that problem, right? The other good news is, we had a bunch of people that came from what I call more entrepreneurial backgrounds that understood sort of business, right? They weren't just building product. They actually came from backgrounds where they had seen a business or they'd worked in a large multinational. They'd sort of seen a P&L, but they'd also seen a cash flow statement, right? And I think the big shift was we stopped talking about P&L and we started talking about cash flows. And I think that transformation may or may not have happened as quickly in the US, but it happened very quickly in India. So today when you talk, and it may be swung too far to the left because now all founders want to tell you is how quickly they'll be profitable. And I'm like, maybe that's not the only thing you should be thinking about at an early stage. Maybe you should be thinking about market share, category leadership, network effects. But if you don't have any of those, then you better be profitable.
I love that. I really, really do. And I think that's incredible that obviously the Indian market itself puts more value over profitability more so than growth. It's so sad. I've literally have talked to conversations with social apps, and they're like, yeah, we got 500,000 downloads, but they maybe only brought in like $1,500 that month or something crazy. And it's just like, dude, but investors want to see that more downloads or more whatever, the growth more so than the profitability. And I'm like, man, I love profitability. I love cash flowing things that actually produce results, which is incredible. I want to ask you, because the secondary market here in the US is something incredible, because a lot of venture capital funds, they may or may not, because again, our US market, the IPO was very stagnant. So the secondary market was very active because of that. They were looking to, you know, liquidate their funds, get some
Right.
DPI for their investors, et cetera, and their LPs. This may not really pertain to you because the IPO market over in India is a little bit more active per se. Did you find the secondary market, as a venture capital, as an early stage investor, is that something that you're actively looking at and saying, hey, look, we're going to go ahead and liquidate 5, 6 years, whatever it is, and then we're going to go ahead and in the secondary market, and you find that the market is pretty
Yeah.
active and attractive, and there are good, bids, or is that kind of more of a obsolete thing, and you're not really focused on that, hence because the IPO is so active?
Yeah. Look, I do think that a larger number of companies have gone public in India. I mean, I think that last count, there were like 4 IPOs in the US this year. So we've had many more than that. But, it's still tough to get liquidity. And I also think there is, venture truly is an outlier business because it's those few very large IPOs that make it really worth your while. A lot of the others mid-market, are good and you'll get liquidity. So I think if I kind of take a step back and look at it through the lens of a fund life, you don't always get liquidity by the end of the fund life on all your companies. And this wasn't a big deal in India till a few years ago, but I think it's becoming a bigger deal now because people are saying, look, thank you for the great markups. And yeah, you give me a little bit of money back, but we're on fund 4 and you still haven't given me money back on fund 1. So maybe we should start flipping some of those positions. So I'd say in the last couple of years, like everywhere else in the world, I think the secondary market has picked up. I think the challenge 2 years ago was that the bid-ask spread was ridiculous. Nobody wanted to sell. And the other side of the table, nobody wanted to buy because they didn't know how to price these assets. I think a couple of years into this journey, that spread has narrowed. And I think people are now able to better calibrate what's an efficient discount to either buy or sell at. So we are seeing more uptick in secondary activity. There are secondary funds, there are continuity vehicles. So I think it also reflects on the maturing of the venture capital industry, which is now give or take 20 years old, that you've had some vintages and you've had some people that are saying, okay, I need to go out and fine, I may leave a little bit of money on the table, but I need to return money to my LPs so that I can go get my next fund going. So I think it's a natural part of the evolution of the Indian market. We kind of forget that Sequoia itself is 50 years old. The Indian venture capital industry is only 20 years old, right? So, but I think the lessons are learned very quickly and translate, much faster these days.
Yeah, and I think it's just such an interesting market. I had first of all, incredible amount of valuations, and it's so interesting because what I get really excited about is to see like the incredible trajectory it is already on, and then yet you're still talking like a large portion of the population is still not even on the internet, or a large portion is not even like fully,
Right.
yeah, and that's what I think is so crazy because I'm thinking, man, what does that growth trajectory look like? And so, Rahul, just being on the ground, talking to these founders, et cetera, and obviously, having credible results with Trifecta Capital. What do you see? What's exciting about you? What you're seeing? You're on the forefront. You're on the
Yeah.
on the ground there, looking at obviously the next 10, 15 years and how it's going to drastically just the trajectory is going to be amazing.
Yeah. No, I feel privileged to be, here at this point in time because, I've had the luxury of working actually with sort of 4 generations of founders in the last 20 years. The first check I wrote was to a company called BillDesk, which was sort of modeled on the PayPal of India way back when. It's the market leader in digital payments in India, probably valued at now $4 or $5 billion. So kind of got involved in that company, spent a little bit of time with the guys at Zomato, which is now a very richly valued company. We're investors in Meesho, which is kind of the 3rd largest e-commerce company. And then most recently, we got involved with a company called Zepto, which is, candidly the fastest growing, tech company in India right now. And so again, in the quick commerce space. So I kind of look at it and the founders are 20, 30, 40, and 50 years old. So I've also had the luxury of working with 4 generations of founders. I think what gets me excited is the fact that in the past, a lot of these founders were happy with small wins. We hadn't seen a lot of wealth creation. Founders hadn't done this journey before. So if somebody said, look, I'll buy your company for 20 million, no problem. Take my company. I'm going to go retire, right? Company like Zepto had standing offers from the 2 other big companies in the order of magnitude billion-dollar valuations, cash, not even stock. And the guy said, no, I think I can build the first $100 billion company in India, right? So the mindset of the entrepreneur today, which is, kind of confident, aggressive, deliberate, execution oriented, and super hungry, right? I think is really inspiring, because otherwise you end up with like small outcomes. I think now that we have seen success at scale, the role models of the founders today are, hey, if Dipinder can build a $25 billion company, why can't I, right? And why can't I build a $100 billion company? So I think the thing that I'm most excited about, look, venture is a people business, right? We always had the technology talent. We maybe even had the hunger, but maybe we didn't have the ambition. And I feel like now we have all of that. And, there is the opportunity that, given the world needs India to be successful, because, as an economy, we're a kind of 5 trillion market cap. It was 3 trillion less than 5 years ago. It's now 5 trillion. Likely the market cap will get to 10 trillion in the next 5 years. And we should double our GDP per capita from, $3,000 to $6,000 as well. So you've got this vibrant market, you've got hungry entrepreneurs, you've got a government that, has provided the platform for innovation and wants to be a developed country, right? And so all of these forces are aligning. So it's not that there's opportunity everywhere, because I think the other truth is it's a shallow market. It's a big market, but it's a shallow market because if you're not number 1, 2, or 3, very quickly you're irrelevant, especially on the consumer side. And so my counsel to investors also is that, look, you still have to be a stock picker. You cannot index your way to glory in India, because the returns will be very disproportionately skewed to a select number of companies. And so what we're trying to do at Trifecta is be the partner in growth to the best of the new economy. And we begin our journey with these companies very early on in their life, which doesn't require us to pick a winner early, because as a venture debt provider, I'm not necessarily saying this company is going to be the winner at the end stage. I'm saying this company over the next 3 years is going to hopefully do well, double in value, and return my money. But our growth fund, which comes in later, says, okay, we're 3 years away or 4 years away from an IPO. I think that this is an asset that could actually get there. And so I have a greater shot at making a great equity return versus coming in as a very early investor and then worrying about the long journey to exit. So we built this sort of barbell approach where at the early growth stage, we get in with a product that pays us out handsomely and on a risk-adjusted basis is super attractive. And then on the growth side, we're sort of shooting fish in a bowl, right? We're like, okay, we've seen the movie. It went from 1,000 companies to 200. Within this 200, we've lent to 100 of them. So let's now cherry pick the best ones that could go public in the next 2-3 years.
It's such a strategic process. So you understand at the beginning, and it's a 0 to 1, 0 to 1, 1. Before I dive into that, I love what you said, the importance of belief. Right? Once you understand, hey, now all of a sudden you have a generation of founders that have been able to produce and create and develop. Now all of a sudden you are following and you're leading a whole bunch of other founders that are right behind them and saying, hey, if they can do it, we can do it, and we can do it bigger and better because the foundation's established. And I think that the importance of just having that belief in the culture and the younger generations is extremely important. And then too, I love what you said in regards to kind of the trajectory where you're like, okay, now we know what's winning. Now all we do is we just do a large growth fund and obviously deploy a lot of capital in that, buy out the other LPs, and then of course, scale it to an IPO. Do you guys take a very operational approach with your founding team and so forth?
You know, the joke, of course, is the best founders need the least help, right? And so, I am mindful of the fact that by the time we come in our growth fund, if the founder hasn't figured out the playbook, it's probably not the right bet for us. So what we spend time with them on at that stage on the growth side is really prepping them from an IPO perspective, which is how to think about governance, IR, corp dev, building the cadence of being a public company. Because that experience is still very young. And so our team on the growth equity side actually came from a combination of public and private market investing, more private equity mindset, because that's the mindset you need if you're going to go public in the Indian market. On the venture debt side, the way we think about it is that the VCs get paid a lot of money to do that work by sitting on the boards. Where we want to spend time is on anything to do with the stock and flows of capital. So on the venture debt side, anything to do with cash flow management, cash flow planning, additional leverage, raising a new round of financing, we think we can provide a lot of value to companies there because we can't be as deeply involved. It's a large portfolio. At today, we have an active portfolio of 120 companies. And so I can't pretend to be an expert in every vertical. And by design, a venture debt fund should be highly diversified. So no more than, say, 15, 20% of our capital should be in any one sector. So therefore, while we have a lot of companies in, say, in healthcare and education and transport and mobility, what we do is we gather data and we try and use that by way of benchmarking. And we say, okay, we've seen these data and trends, say in consumer products or in financial services. And this is the benchmark for best performance. And so what I can do is I can go back to my companies and say, look, I don't know your business better than you do, but I know 5 companies in your sector, and this is how they're doing. So our value addition is to help companies have better benchmarks, to have a better sense of how their peers are doing, and to therefore make sure that they're not falling behind by way of what is market practice.
Yeah, and what's so unique to me is I think I hear a lot of VCs and a lot of later stage founders or capital allocators, and they say, yeah, we are very operational heavy with our founders, but many times it's more of just a check writer, and they just move on, and then they follow on with their successful companies, and they do follow-ons, et cetera. And the reason why I'm saying that is because you see in this kind of ecosystem, a lot of founders get hurt because they want their help. They want the venture capitalist help. They want their team. They want their resources. They want their Rolodex of other amazing relationships, et cetera. And yet sometimes that's not there. And so that's why I think it's really important to hear that, where how involved are you with these founding teams to be able to, because sometimes, at the end of the day, you come in, and then this is one of the reasons why as a family office, when we are pushing out our venture capital arm, we said, okay, when we're looking at this, we don't know all these industries, right? We want to get in space, we want to get in defense, we want to get in AI, but we don't have the infrastructure, the team, the deal flow, all that stuff. So what we decided to do was, well, we're going to go ahead and take GP stakes of each one of these funds, and we're going to underwrite those teams and underwriting that kind of structure, because they're the ones that have the infrastructure of the team, the deal flow, the underwriting, all that fun stuff. And that just seemed to work for us because, again, now it's more a larger goal, but now we're relying on that team to go out there and underwrite those founding teams, et cetera. And so I want to ask you, go ahead, Rahul.
No, I was saying that, in a way, I think about venture as a pick and then a play, right? So the younger the company, maybe the role that you play with them in terms of helping build that capability set needs to be a lot greater. And firms like Andreessen and now Sequoia have built very large specialist teams to go do that, right? I think by the time we get to the growth side, it's actually, in a way, picking well becomes really, like, you can't do well if you pick poorly even at early, but the relative value add that you can provide and that the founder needs is far greater at early stage than at growth stage, right? So when we said, look, what is our right to win? And if I go to an LP and say, why should you give me money? I'm not pretending to be the guy who is telling the founder how to run his company. I think that would be disingenuous. What I'm telling my LPs is these founders are amazing, but you know what? They've never taken a company public. And really, the biggest challenge for them is actually building the narrative around what makes for a great public company. How do I structure my board as a public company? How do I manage my quarterly earnings as a public company? How should I think about comps as a public company? How do I manage governance and regulations and all the stuff that could come hit me differently as a private company? So what we've told our investors is that in our growth fund, one, you're paying me to pick winners versus losers, and I have a winner's chance of getting in because I know these companies. And then you're paying me to provide alpha by way of making sure that they have a great exit by way of IPO and not an average outcome. So again, it's very contextual because, Chris, there's a whole ecosystem in the US that's taken thousands of companies public. I go back to the days of Mary Meeker before she ran her fund. She was an equity analyst, right? And so you had her generation of people educating investors in the 90s as to how to think about an eBay, right? We have to play that same role in India by actually doing the market making, doing the evangelical work to sort of build the understanding so that the public market investors take these companies seriously.
Yeah, it's the whole handoff and the whole just kind of the
Yeah.
whole structure of it, man. Raul, man, it's been such a pleasure having you on, and I think it's so fun because our goal here on the journey on our podcast is to be able to highlight certain industries outside the U.S. and certain markets that are making huge tailwinds, and it's just sad to me the lack. A lot of investors I talk with, they mostly focus on US deals, and that's okay, but very
Yeah.
few of them focusing on international deals. And that's one of the reasons why I want to have you on and discuss this and the exciting opportunities out there. And I know US itself has a good relationship geopolitically with India, unlike China and Russia. It's kind of like, a hot
Yeah.
water right now, but India and US have a good geopolitical relationship, which is always good. And that means as an investor perspective, that means, your money's safe,
Absolutely. Absolutely.
contextually. So,
Yeah.
Raul, how can my audience reach out to you, or how can they connect with you,
Oh,
or how do they, just learn a little bit more, man?
yeah. So look, we've had the privilege of working with a few family offices in the US. And I don't know if this name rings a bell, but I'd say he's now become more of a friend than just an investor. A gentleman called Ashton Newhall. Ashton founded a firm called Greenspring, took it to 16 billion of AUM, sold it to Stepstone, was the CIO of Stepstone's venture program for a few years. Recently stepped down, to start his own single family office. And Ashton, is the reason I come to Palm Beach because he has this lovely home and we meet once every 6 to 8 months. And I think what's interesting is that, Ashton has a worldview because at Greenspring, they were investors in a lot of different venture capital funds and different strategies. And when he reached out to me 3 years ago saying, I want to do venture debt in India, I was like, why? Right. And his honest answer was, hey, I think venture debt is a great way to build a view on the Indian market. I don't need to wait 10 years to know if it's working. You guys seem to have built a great track record. You have lots of institutional money. And the Bessemer guys think really highly of you. So we began a relationship, and I was in his home a year and a half ago. And he said, Rahul, tell me your favorite company. I said, look, I've got 120. I can't tell you one, but I think Zepto is one you should look at. He led that round at $1 billion valuation a year and a half ago. They just closed their last round of financing at $5 billion. So Ashton is my new best friend because he said, just show me one of these every year, right? Just show me one where I can 10x my money. And it was a $100 million check for them, right? So look, I think we welcome, conversations with people that are excited about being invested in India long term. I think the way Trifecta can play a role in that is to help you build a market map of what's going on the ground, give you access to the venture asset class, either by way of venture debt or by growth equity. And depending on one's risk appetite, play both or play either, right? And so I'm around, I'm on LinkedIn, we're on trifectacapital.in. And I think for those that would love to learn more, I'm happy to spend time with them.
Awesome. And guys, I'll put all those links in the description below, so it makes it nice and easy and simple. And that's a really cool investing relationship as well. I mean, that's really what it comes down to, is just relationships, the synergies, and then, we all make money all at the same time doing some cool shit. So, and that's really cool. Guys, that is my friend Rahul Khanna from Trifecta Capital, managing partner. And until next time, be uncommon if you can. Rahul, man, that was